we've already started that process of basically defaulting on people who in the late 2010s were happy to own currency and happy to own bonds. And if you own equities, if you own gold, if you own real estate, if you own Bitcoin, that was the trade to be in. What replaces the dollar is not something that looks like the dollar. Bitcoin is a really powerful one because it's not only a reserve asset, it's also a settlement network. I lean toward this next quarter being probably pretty favorable. I do think it's likely going to be a good quarter.
Lyn, great to see you again. Great to have you. And I believe, if I'm not mistaken, this is maybe one of the first times that I've gotten to do a one-on-one with you. Usually you're sitting on a panel with a bunch of other Bitcoiners, but I get a little bit of one-on-one time with you. And I'm going to preface this by saying, in advance, apologies. I am a layman when it comes to a lot of this macro stuff, and I try to take a listen to some of your takes on it, and I do find them illuminating, but I may phrase certain questions in a way where I'm asking some of the dumb questions and trying to get you to maybe explain a little bit of the bare bones basics, if that's all right with you.
Sure. Yeah, sounds great.
Awesome. And how are you, by the way? You've been doing okay?
Pretty good. Yeah, trying to, I have my head down on a lot of things, working on some big stuff, and currently kind of traveling less and just kind of focusing on, kind of the next cycle, I guess we could say.
Fair enough. And I mean, kind of a good term to start the conversation off with. First off, in the realm of cycles, happy October. October's been treating us well so far, the first little bit. I had maybe a dumb question for you, but we saw something that doesn't happen super often in Bitcoin, in that we had a green September, and that's only happened a handful of times in Bitcoin's whole history. And October is typically, I believe, like this historically the second best month typically for Bitcoin. So my first question is, why would it be that September is typically a bad month for Bitcoin? And is it a bad month for markets as a whole? Why is that?
So it is historically not a good month for markets as a whole. And this also was an exception for those markets. So stocks did well in September, despite historically it not being one of the better months. There are a whole kind of analysts that focus on that seasonality trend. There is pretty good data going back. Some people, I think, over rely on it. So it could become almost like astrology, like you assume it's going to be bad. But there is some truth to it. I think one of the main explanations for the September effect is that a lot of people on Wall Street are basically on vacation in July and August. It's not really focusing on trading as much. So there tends to be like just lower liquidity. Things are kind of on autopilot. But then once after Labor Day in the US, everyone's kind of back, locked in again. And some of them will reevaluate and be like, this thing's trading at what now? And like sell that, or like rebalance that, or they kind of get more locked in. And so it kind of sobers up a little bit. Also, the political season kicks into full gear. So things that were kind of on autopilot politically in the summer often kind of get back into full swing, which sometimes has negative catalysts, sometimes positive catalysts, depends. And so, yeah, historically, September is a little bit tricky. And similarly, December, especially late December, historically, statistically speaking, leans favorable for markets because there's like they call it window dressing in many times. So the quarter end is very important for many companies, and especially the year end is even more important to the final quarter. So a lot of things are kind of dressed up on their books in the past, like the last kind of couple weeks. There's also tax related stuff that happens, and so it's not really a complete accident that September tends to not be amazing, in September and December tends to be pretty good.
Okay, fair enough. Now, would you, I know you just referred to it as a little bit of astrology here, but do you give credence to the fact that historically in Bitcoin, the 4 prior times, this being the 5th that we've ever had a green September, we've had incredible fourth quarters of the year for Bitcoin. I think they average out somewhere in the 50% upside range. Do you think that that trend is going to continue? How are you, given the September and beginning of October that we've had? How do you see the rest of the year playing out?
So it's a little skewed by the fact that Bitcoin has had a handful of like 4-year cycle, ridiculously good fourth quarters.
Mhm.
So some of those numbers are insane, and then that can overall skew the whole data set. Um, but so I kind of don't put a ton of weight into that, even if for separate reasons I lean toward this next quarter being probably pretty favorable. I don't really specialize in 3-month predictions, but overall, I do think it's likely going to be a good quarter. Not necessarily because I'm saying, okay, because September was good, I think this is going to happen. It's more like when I look at a combination of things. So some of the paper Bitcoin summer stuff as kind of reset. Froth got, air let out of the balloon, whatever analogy you want to use. One of the indicators I look at, again, there's no perfect indicator, but one of the ones I look at is on chain, market value of Bitcoin. So the whole kind of market capitalization compared to on chain cost basis. Which isn't a perfect encapsulation of things, but it is a useful signal. And when that ratio gets really high, so when market value is really high compared to the cost basis, it tends to trigger more profit taking. The market, the cost base has to catch up for a period of time.
Can
And
you, for anybody unfamiliar, can you just mention what is the on-chain cost basis?
yeah, so there's different ways you can look at. So cost basis of an asset overall is basically what price did people buy into that asset. So if you
Mhm.
bought your house at a certain price, then regardless of what it is now, you have a cost basis. Same thing if you buy a stock and it either goes down or goes up, you've got a cost base. That's your entry point.
Mhm.
And of course, if you have multiple entry points, you can average them together in that weighted way and get your average cost basis. And when we look at basically market capitalization can be a little bit misleading. Sometimes I use the analogy of a street with houses because it provides a somewhat illiquid example. So if you have a street with 20 houses, they're all $500,000 each, and they haven't traded hands in a while. And one of those neighbors finally sells their house for 600,000. They've sold at 100,000 gain compared to the prior kind of assessed market value. And what will generally happen is all the houses on the street will kind of re-rate higher because now there's a fresh new data point for what houses on the street are worth. In this example, we're assuming they're practically identical. So even though a fairly small amount of capital changed hands, a $600,000 buyer came in and the existing holder sold, if every house on the street goes up by $100,000, that's a $2 million market gain for that street of houses.
Right.
Um, and that, to a less extreme effect, happens in Bitcoin, which is if you've got pretty tightly held supply, kind of all the fast money's gotten out. What's left is kind of held by pretty diamond-handed people and entities, and then for whatever reason there's an influx of new demand. A fairly small amount of income and capital can have a 5x multiple, for example, on market cap because a fairly small number of coins are trading hand. And when we do market cap, we're just saying, well, what's the current price of a coin multiplied by all the number of coins that exist.
Right.
But that's not necessarily the price that it would take to actually, if you want to buy more of them, the price is going to go pretty rapidly. And so whenever market cap gets kind of really ahead of itself, it can be a little bit of a warning sign. So historically, the 4-year cycles of Bitcoin ended with extremely high multiples. That level of euphoria is kind of off the charts.
Yeah.
Um, Another way of putting it is that going back to the house example, if that one house trades hands and all those houses are now assumed to be $600,000 houses, that's kind of a fragile assumption. It says, okay, this one traded hands for that much. But if 4 more neighbors all say, oh, our house is up now, we want to sell, you might not necessarily get 4 buyers in that street for 600,000. So, but after, maybe after 6 months or 12 months, if there's another data point that's at, 600,000 and maybe another data point slightly under, another data point at 650,000, whatever the case may be, it starts to lock in the view that basically this is now the true new market price of the street, at least currently. And the average cost basis is rising because in that one example where the one house trades hand, the cost basis of the street has barely changed. So it used to be the cost basis was 500,000 per house. Let's say one house traded hands for 600,000, so you added 100,000 to the total cost basis of that whole street. But as you get 2 houses, 3 houses, 4 houses changing hands, you're starting to inch up the average cost basis of that street, the actual amount of capital put in as entry prices. And
Mm,
that's kind of, it's psychologically important for investors,
yeah.
the price that they entered. And in Bitcoin's case, we, of course, data is a lot harder to come by than a 20-house street, because we don't know exactly what, the volume of exchanges. A lot of it's self-reported. Some of them are publicly traded, so the numbers are more serious. But we don't know the exact volume of exchanges. We don't know every price that everything traded hands at. So, but one of the data points we do have is when coins moved on chain, what price were they at when they moved? And one of the biggest sources of moved coins is coins going to exchanges or from
Mhm.
exchanges. And generally speaking, the moment at which people pull coins from an exchange into their wallet, that's a pretty psychologically important number.
Yeah.
That's like a type of cost base. Even though it's not necessarily the price that they bought at, it's the price that they made a HODL decision at. And that's the
Yes.
data that we have is kind of just locked in there. And so I do look at the kind of the multiple. So generally speaking, when the market cap gets a little frothy compared to the cost basis, either you're more likely to kind of tread sideways in market cap and cost basis will inch up as more trading happens at that new higher level,
Yeah.
or sometimes the opposite happens and market cap falls quite a bit and kind of catches down if it was kind of a brief uh, period of euphoria.
In this new kind of era of increasing institutional adoption, is it harder to pin down that data with on-chain movements versus having to rely on, again, these centralized entities and their reported trading volumes?
Potentially. I think over time that signal could lose some of its value. I don't think that's the case yet because I mean there's always been a history of like the number of coins that were in Mt. Gox at the peak,
Yeah.
the number of coins, that were in Binance, the ratio of coins. So these things have always been somewhat concentrated and even like GBTC, people talk about MicroStrategy getting a lot of coins or BlackRock getting a lot of coins and all these ETFs. I mean, GBTC had well over 600,000 coins before ETFs were even launched and before MicroStrategy got anywhere near as big as they currently are. And so while it is true that more coins have ended up in ETFs and Bitcoin treasuries like MicroStrategy or MetaPlanet, it's we're not starting from zero. We're basically starting from whatever GBTC was, over 600,000. So if the number is twice that, you've added 600,000 coins to those pools, and some of that's not all that's say from self custody. Some of that is from coins that would historically sit on exchanges, or sit in a little bit more cold storage parts of exchanges or institutional things like that. So I wouldn't say it has a massive effect so far on the data compared to prior history, but over time, it certainly could.
Okay. I want to change gears a little bit and go a little bit more broadly macro. And first, I kind of want to start with um, this year so far, I guess, US centric. Obviously, the new administration coming in with, kicking open the door and a lot of talk of, hey, we're gonna try and cut spending and we're rolling out Doge and a lot of big talk, but then we saw kind of the rift between Elon and the administration
Yeah.
when seemingly all of the efforts of Doge were quickly undone by multiples based on the amount of spending that was going to be happening. Do you think that on the part of the administration, there was indeed a sincere attempt to actually directionally fix things, and they quickly began to understand that you just can't really do that? Or do you think it was political theater? Like, how do you interpret what's gone on this year in the U.S.?
I think a lot of it was theater, but it's not equally from every participant. For example, it's possible that Musk thought something that's different than what others in the administration thought. They're not all one mind. Like any king's court has multiple factions in it, and presidential administrations are no different. Like in this case, there was kind of the pro-tariff faction, and there's like the little more free trade faction, which Musk would have been more aligned with. Um, I think the part where I call it theater is that this was obvious in advance, I would argue. And as proof of that, I mean, Sam Callahan and I put out a report. So he wrote it, I advised it, and commissioned it on my website. It was started to be worked on in 2024. It was published, I believe, in January 2025. So the beginning
Yeah.
of all this, explaining essentially why nothing stops a train, but in particular, there's a really
Mhm.
big section outlining in detail why Doge is very unlikely to have like material macro effects. Not to say that they can't gut program XYZ or do that, but it's like when we're talking numbers. So we quoted, I mean, they were talking about cutting $1 trillion from the deficit within a year or so. I mean, the initial headlines are basically getting rid of the deficit, so 2 trillion. But then they quickly said, okay, $1 trillion, and we were like, here's why that number is not going to work. So it's not that those effects were undone; it's that those effects were never going after the core issues to begin with, which is if you look at the pie chart of government spending, it's like a really big chunk is Social Security. Another really big chunk is Medicare. Another really big chunk is Department of Defense and veterans benefits, and another really big chunk is interest expense. And those are the things that are either impossible or extremely politically or voter-wise unpopular to cut. The part that they were going after is like the 15% of the pie chart that is like everything else,
Yeah.
the transportation, parks, Department of Education, and like say what you will about those, it's a much smaller part. And those big ones, except for the DoD, like interest expense, Social Security, Medicare, they're not employee-heavy areas. They're transfer payments. They're huge monies going around with a tiny fraction of the government employees, and most of the employees work in that other tiny, spending amount, like the FAA or the, uh, park and recreation, all that stuff. That's all the employee-heavy stuff, but actually, ironically, smaller spending areas. And so we were like, look, what they're talking about, what they're actually going after is pennies on the dollar. Because they're not going after the core things, nothing stops this train. And then we saw the big beautiful bill came around and just kept the train going. And so where I think it's somewhat theater is that instead of acknowledging on Musk's part that hey, we actually never really had a chance, we were going after the wrong thing to begin with, that would look awful. Instead, someone else has to be at fault. And it's like, well, we were doing this and it would have worked, but you got in my way or XYZ happened. Whereas I argue, no, you were actually not even ever going after the core issue. And then an underlying point, and this happens frequently, is that when difficult decisions have to be made, in politicians will often, and this happens both on the right and the left, is pretend that there's no loser from this, or that the loser is so small and unimportant that it won't matter. And there's a couple ways to do that. One is the grow your way out of it conception,
Yeah.
which, and again, these things work because they have a grain of truth in it. But then it's like, so yes, growth matters, but the idea is that well, we have high debt, we can just grow out of it. But generally speaking, whoever's holding those bonds and currency is still getting debased compared to whatever you're growing into. Um, and so for example, often when you see unfunded tax cuts, so they'll cut taxes without cutting corresponding spending, and the argument is, well, we're not really just accelerating the deficit because we're going to get some growth figure that's going to make this all okay, and you never really get amount of growth, so you end up contributing to the total debt. So that's one, and then two, let's say you want to cut spending and you say, but if you tell voters we're going to cut all the things you care about, like good luck, right? I mean, if you look at Social Security, Medicare, I mean, the especially the seniors are the ones that vote, um, and they're third rails for a reason, kind of. I mean, the 2010s Paul Ryan era, the Republican Party, they gave it a pretty solid shot to try to trim some of this. Never really had enough consensus to do it. The current version of the Republican Party, the Trumpian part of it, is less fiscally conservative than the 2010s version of the party. They kind of acknowledge these are third rails, um, and so instead, the narrative among politicians is basically that there are areas of such vast waste that we can cut, and apart from a handful of special interests, it'll be like painless. And the problem is, like again, that's the tiny part of the pie chart. You actually can't do massive cuts unless you're after the really big things, which are either popular among voters, or I would say the biggest area that they could have gone after is Department of Defense. That's the one giant area where there actually is a lot of employees, a lot of spending, and that the classic thing of like the Pentagon never passes an audit, despite all the money going there. Now the problem there is less voters and more politicians and lobbyists because every member of Congress that has something defense related in their precinct, which is really big share of them, will generally defend that thing in their precinct, because that's that indirectly that's voters. That's that's especially like very economic workers. They say,
Yeah.
no, we don't want to cut this program. Maybe you're making tanks that don't even matter anymore, like a certain type of tank that, generals say, I don't think we need that tank anymore. And then, but the congressperson is still going to defend that tank being made in their precinct because it's jobs and it's whatever contractor might be involved in all this. So
Yeah.
going after that is like hard mode. And that was the part that they maybe could have applied more pressure to, and it made a little bit of a dent, but they didn't really even do that. So I think the Doge thing was kind of dead on arrival. And then the second thing is tariffs, which has made more of a dent. And that's why I've actually followed that closer, because that is more macro impactful than Doge, which is mostly non-existent.
Yeah. It kind of sounds like, again, to bring it to an individual level, it's like somebody living in a house where their paycheck doesn't even cover the mortgage, but they're saying that they're gonna, cut out their lattes and make them at home.
Yeah,
exactly. Like, it's really not exactly moving the needle meaningfully. Yeah. Bitcoin Well is the best place to be buying and selling Bitcoin in Canada and the US. And now with Bitcoin Well Infinite, it's also the best place to be making large buys at their OTC desk of over $50,000. Their white glove service gives you fast transactions, no slippage, and the lowest fees. You can scan the QR code on the screen or simply head to bitcoinwell.com/BTCsessions to sign up today. And you can share your own personalized referral link to earn commissions. CoinKite has been in the game for years, creating hands down the best and most secure hardware when it comes to securing your Bitcoin. The Cold Card Q is an absolute powerhouse and my daily driver, and it's ideal for newcomers and advanced users alike. The Tap Signer gives you a low-cost, user-friendly option for those just getting started or for convenience when traveling. You can head to coinkite.com and use code BTCSessions for discounts, or simply scan the QR code on the screen to get started right away. DEBIFI is the best and easiest way to borrow against your Bitcoin in a non-custodial way. Funds are held in a multisig escrow where you hold a key, and the platform allows for excellent hardware like the Cold Card Mark IV and the Q. You have access to flexible conditions, the best rates, and institutional-grade liquidity. If you're looking to make use of your capital, don't sell your Bitcoin, borrow against it. You can head over to DEBIFI.com to check them out, or simply scan the QR code on the screen. Now, in terms of U.S. debt, I believe we recently passed 37 trillion. Is that correct? I think
something like that. Yeah.
Yeah. And I wanted to maybe talk a little bit about something. Historically, there's been a level, and maybe you'll enlighten me on what the ratio is, but the debt to GDP ratio or threshold, where historically speaking, it's typically been an indication that there's going to be a default in a lot of various nations, either nominally or just through printing, like a soft default. Now, up until very recently, the example that was kind of held up as, oh no, see, this works fine, is Japan. But Japan has had some interesting troubles this year. And I'm wondering if, one, you could maybe bring to light, what is happening with Japan? Why were they able to kind of duck and weave their way around that threshold of debt to GDP that seems to be the kiss of death everywhere else? And secondly, how, the US debt to GDP is getting up there quite a bit. And how does the dynamic of them being the world reserve currency play out in relation to this? Do they get a free pass? Is it just a little bit more of a kick of the can down the road? What's the end game here? So I know there's a lot there, but I'll let you go ahead.
Yeah, lot there, but great questions. I'll start with the first half. So to quantify that, and this is kind of, I think, indirectly the study you're referring to, and this made its rounds years ago, and I also cited this a number of times, which is There was a study that showed that when countries reach 130% debt to GDP on the public level, there's a 98% chance that they're going to default in some way over the next 15 years. And it was a sample size of something like 52 entities, public, sovereign entities that reached that level. It was over a very long period of history. And that one exception, so the 1 out of 52 that didn't have what could be considered a default over the next 15 years was Japan. That they managed to kick the can down the highway even at that level longer than anyone else. And what they define as a default is not always a nominal default, but it's either if it's an emerging market where the debt's not in their own currency, it's likely to be a nominal default. But other times it's a major debasement where bondholders get a significantly reduced purchasing power from their bonds, even though they probably got paid back every unit that they were owed, on paper.
Yeah.
And so when you get to that level, there's going to be some sort of default. And the question is how, or are you the 2% exception? In Japan's case, and I actually wrote about this. I don't know if it was 2022 or something. It was years ago, explaining why Japan following that one exception is not the one to point to. So a lot of times in the U.S., when people talk about the debt, the deficits, they'll say, "Well, look at Japan, and we're fine for now." And the problem is we're not Japan. And then my argument also in that article is that even Japan's not Japan anymore.
Yeah.
To your point, and since then they've had some major issues. So my point is Japan's no longer Japan, and U.S. never was Japan. So the reason that Japan had a number of ways to go longer, one was although they had the debt, they also had assets. So if someone is 200,000 in debt and has no assets, they're in trouble. If they have 200,000 in debt but they have a 300,000 home attached to that debt, that's a very different financial situation.
Right.
That's an extreme example, but Japan was more in that situation, which was they have a ton of sovereign debt, but they also had years, like decades of current account surpluses, trade surpluses. They were the absolute powerhouse in the 60s, 70s, and 80s. The people at the time. That's why all the cyberpunk literature that came out in the 80s was always centered around Asia and stuff because that was
Yeah.
and in Die Hard.
Yeah.
They were in a tower owned by a Japanese company because they were just dominating for a brief period of
Yakatomi Plaza.
yeah, a brief period of time. Japan had a bigger stock market cap than America, with a fraction of the population, and it's because part it was overvalued, but also they were just dominating, um, and they basically saved it. It's like they ran a really big surplus, and they're kind of retired now, but they're that retired person that has debts but also a ton of money. It's kind of what they did. So they have one of the largest net international investment positions, meaning they own things throughout the world. They own stocks, they own bonds, they own shares of companies or mineral deposits around the world that pay them dividends and interest and commodities when they things like that. While they also have a lot of debt, and then the second thing is that they even to this day, despite their demographic issues, are extremely productive. And they've got a unusually high level of societal harmony, which is it's a type of human capital. If you've got a very free and organized place, you have to spend less money on security, less money putting out fires, less money just surveilling everyone to try to make sure no one's going to blow something up. It's like you spend less on the problem areas because everyone's already kind of working together and there's less extreme things happening. Two, the median age of Japan is like 10 years older than the US, but they spend something like a third on healthcare that we do, and they live longer.
Yeah.
And it's partially diet, it's multiple other factors. The US, the meme is kind of like we pay 3 times per the same pill that everyone else in the world pays for the same pill.
Yeah.
We've got a weird hybrid system of healthcare that's a problem. But basically, and they also pay much lower percentage on defense. So even though they're running big deficits and stuff, it's actually mostly going to the people. Like it's like they're debasing themselves slowly, but it's not as though it's being siphoned off into corporations and black boxes. It's actually mostly flowing back into the people, so that there's more of a tolerance for it, you could say. Now they still have other issues. Like the complete reduction in fertility, the social isolation that happens there. I'm certainly not an expert in those things. So they have paid a price, either correlated or caused with this whole endeavor. But mathematically, they've had much more resources to deal with their debt cycle than most other countries that reach that level. And so I've always been kind of a Japan bull ever since kind of the whole past decade. So they've had a famous lost decade in equities, but it's not been a straight line. They actually bottomed back in like 2012, and it's really been a strong equity market ever since. Um, and the current, I certainly don't want to be long the currency, but you can be long equities that ironically themselves are often short the currency. They have debt in Japanese yen, and I'm like, all right, I'll own assets at historically good prices that are have their liabilities in yen. All right. Um, and so, it has been an interesting thing. Now, most countries, and when they do get to that fiscally dominant stage, you're more likely to default. And even now, Japan has kind of reached, I would argue, the end of their multi-decade deleveraging cycle in the private sector, and they are entering more inflationary times. Another kind of key thing is that um, Japan aged, but the rest of the world, they were first to age essentially. The rest of the world, you had the rise of China and everything. So you had this kind of still like productive disinflationary period in global history that Japan could benefit from. So they could get cheap labor from China, and they can get cheap labor from elsewhere, and they get cheap soybeans from XYZ. So even though Japan had certain limits, the world didn't. Now, the problem is when China ages, when the US ages, when Europe ages, when all of these other things kind of are in Japan's situation, there's no newcomer China. Like China is now old, US is old. There's like it's not like India is still on their ascent, but that's not big enough. It's like it's not big enough to fuel all this. Or like Nigeria is still in the there's not enough like emerging markets to fill that hole. So the world now is entering an older arc, and it's very different when everyone enters it versus when the one leading country enters it.
Right. Now, in that same vein, again, Japan was able to sidestep this stuff. The U.S. Is, if I'm not mistaken, I was trying to look at a stat. I think they're in the realm of 120% debt to GDP, somewhere in that ballpark. How much of a problem is that currently versus how much it may be in, say, the coming 5 to 10 years or so? And does the US's position give it a little bit of a mulligan here, or is it all bad? Do they maybe just kick the can down the road a little bit further? How does this all equate?
Yeah, good question. That was the second part of your prior question that I didn't get to because it was sorry
Huh.
about that. So basically, yeah, the U.S. is at 120% debt to GDP or so, um, and we're kind of at the part where our deficits are flowing back into the economy nominally, and so all the numbers are kind of rising nominally. So we don't really have rising debt to GDP so much anymore. It's like both figures are going up, and debasement's taking the hit. Um, Over the past 5 years, so I wrote my kind of my bond bubble article back in 2019. And I've been reiterating ever since, which is to say that when you enter fiscal dominance, bonds get killed essentially. And these past 5 or 6 years have been like the worst period in treasuries in like modern history. Like you go on these like 2 century charts, and it's like this is like the worst or second worst. It's like awful. So in some ways, it's already mattered. We've already started that process of basically defaulting on people who in the late 2010s were happy to own currency and happy to own bonds and making arguments for inevitable disinflation due to demographics, or whatever their arguments were. We just said, okay, you have fun holding that stuff because, and we just killed it. All the money printing, all of the ongoing deficits. We just currency holders and bond holders just really took the hit. And if you own equities, if you own gold, if you own real estate, if you own Bitcoin, and especially if you had some degree of short on the currency tied to those things, like either a mortgage or MicroStrategy with their fiat currency shorts and Bitcoin longs, whatever the case may be, then you juiced up that was the trade to be in. Now, I still think we have longer to go for these things because the debt's not fully devalued yet. The problems are still happening, but that's kind of the down payment of the default, which is like that's
Yeah.
the opening volley of the default. So it's already mattered. The couple milestones to watch is one. So the U.S. Social Security Fund So how much debt we have actually depends on what you look at. So there's some of the debt is held by the government, ironically. It's intra-government debt. And that's a lot of that is tied to the Social Security fund. So our like external debt is something like 100% of GDP or a little over, whereas our full debt is like 120% plus because some of that is owed to Social Security and things. Now that's in drawdown mode for the first time like ever, really. And so
What does that mean?
what that means is that for decades, more money was going into Social Security than coming out of it.
Mm.
And that's largely demographics. So baby boomers being a particularly large generation, as they worked, especially as they entered their high income years, all that money's going into it. We don't have that many retirees. When baby boomers entered their retirement years, and there's no big generation behind them, they start pulling money out of it. And we never really like we have these entitlement systems in place that are not they were kind of designed as though every generation is going to be bigger than the prior generation. We kind of Ponzi their math a little bit. And so as we get a slowdown in fertility and immigration and other things like that, the next generations just aren't as big. And so you have more retirees per worker, which is a problem. And so now we're in drawdown mode. So we have something like $3 trillion stashed into the Social Security Trust Fund, and that's now drawing down. And the estimated depletion date is somewhere around 2034, 2035, depends on a few factors. Um, and when that runs out, unless there's kind of like legislation to something to kind of direct money printing toward it or something like that, because they're a separate pool of taxes than other things, um, then Social Security checks could be cut going from that point going forward. They could lose like a third of their value or a quarter of their value going forward because there's not enough incoming money to cover it. So it's already the case it's not enough incoming money to cover it, but because they have that $3 trillion trust fund, they can fill the difference by drawing that down. But when that's drawn down, certain decisions have to be made. Either you kind of keep printing and do all the legislation you need to make that happen, or we get politically gridlocked and there are some defaults basically in Social Security entitlements. So that's something to watch. The broader question of does the dollar's reserve status give us a free lunch on this? It both helps us and hurts us because it gives. So I've made the case multiple times that, and I'm not the only one to do it, that the dollar's reserve status gives us strength, but it also gives us weakness. So unlike Japan, to my prior point, they ran decades of trade surpluses. They built up this big war chest of assets because of it. The US, in order to support the reserve currency, we run structural trade deficits. Another way of putting it is that the whole world needs dollars because it's the global reserve currency. They use it for cross-border lending. They use it for currency trades. They use it as a reserve asset. They use it for international unit of account contracts. They all need dollars, trillions of them. And the question is, how do they get them? Well, the answer is they basically overvalue the dollar on a trade basis. So they boost America's import power. They hurt our export competitiveness for lower margin things, which generally means physical, manufactured stuff. So we run these structural trade deficits, and we spew dollars into the rest of the world year after year after year, and that's how they get dollars, which they need to use dollars as the global reserve currency. So those two things are kind of tied to at the hip, which now is politically a problem because when you run 4 decades of trade deficits, you hollow out your industrial base. If there's a pandemic, you can't make ventilators. You find out that a shockingly high percentage of your rare earths or circuits or other components of your military are built by your potential adversary that you are worried you want to have those military assets because you're worried about, which is a problem. And that's been known for a while, and it's kind of finally hitting its head. And so the dollar status gives us a lot of kind of extra resilience for a while, but the other analogy that I've used in broken money is like a box that doesn't feel pain. It seems like an advantage, and for a while it is. Like if one boxer feels pain, the other one doesn't feel pain. And there's actually some people that have that condition.
Yeah.
At first you're just dominating because you're untouchable. The problem is pain is a signal to adjust, and if you don't have that signal, you just ignore it. You could break your arm and just keep going, but eventually that damage accumulates even though you don't feel it, and you can't even get up. Whereas someone who could feel pain would fight more defensively, make adjustments, and protect themselves better. And so the United States, by having the global reserve currency, and forcing us into our massive twin deficits of fiscal deficits and trade deficits, we are hollowing ourselves out, and it took us a long time to truly feel the pain. Some pockets, felt the pain, the Rust Belt, so Detroit and all of Ohio and parts of Pennsylvania, and basically the whole area felt it. But they were not they were the minority compared to all the capital being put elsewhere. But now it's kind of hit the head where it's actually starting to be felt more broadly. And the problem is we're kind of the boxer that doesn't feel pain, but now has trouble even getting up because
Yeah.
we've taken so many hits while not really feeling it. And that's the problem. Another way of putting it is that a normal economy kind of stands on its own 2 feet. The U.S. is like this really imbalanced economy with really big strengths and weaknesses. So we're kind of like someone who's pushing really hard against the wall, and if that wall breaks, we just fall over because we're not balanced in and of ourselves. We're kind of reliant on this ongoing thing. So basically, the loss of like using reserve currency eventually kind of hurts your ability to still be the reserve currency because you no longer have the industrial base, the military strength, the rule of law, all these kind of things that for the reason why we're the reserve currency, we start eating those away, kind of like drawing from savings until we don't have several of them anymore. Or at least the metrics on those things have all decreased substantially. And it gets bad enough where we kind of lose that. And the problem is when we lose something that we're kind of built as though we always have, we can get hurt a lot more than a country like Japan usually will, because we're now in a position of weakness on more fronts than they were.
Now, in talking about the U.S. in this position of exorbitant privilege, how secure do you feel that position even is? Because we've seen in the past years nations decide to no longer use the petrodollar and exchange oil and other currencies. What I'm trying to get at here is there any? Does anybody have a shot at taking that spot in the coming? No, straight up no. How do you interpret the attempts at this by, say, like the BRICS nations and all of that? How do you look at what they're trying to do?
Yeah, amazing question. And so I would describe it as moderately insecure. The reserve currency status is moderately insecure, which is it's kind of like more like it's inevitably insecure, but it's not immediately insecure. So you kind of break that into time versus likelihood. So high likelihood of being insecure, but I think takes a while. Couple ways to measure it. One is that unlike most currencies, so like Egyptian pounds, no one outside of Egypt really needs Egyptian pounds. So for whatever reason, if they don't want Egyptian pounds anymore, they all tomorrow they could just sell them, and Egypt could go into a currency crisis. Especially if they don't have the reserves. For a little while they could use their own reserves to prop it up, but then if they run out of those, the currency could just collapse. And that's true for really any most countries in the world, other than maybe the top handful. Now the U.S., in addition to optional holding of dollars and dollar-denominated assets, which could change if the perception changes, we also have inelastic demand for our currency as the global reserve currency. And one way to measure that is, like, for example, the Bank for International Settlements estimates that there's something like 18 trillion in dollar-denominated debt held outside of the U.S. that is mostly not even owed to the U.S. It's mostly owed, like an entity in Brazil will owe dollars to an entity in China. It's neither of their currencies, but it's this big euro dollar system. And it's this big interconnected web of securities and loans. Plus, that doesn't even count the certain derivatives. And all of that, if you have a debt in something, it's inflexible demand for that thing. Now you could default on it, but then if you're the first one to default, other creditors are like, well, we're not gonna finance that entity in Argentina anymore. We're not gonna finance that entity in Zimbabwe anymore. Obviously, big ones like China or Brazil are kind of like they're more buffered. They have so and then so creditors could potentially default, like, but then it's like, well, there a lot of entities will owe dollars, but then there also others owe them dollars. So the question is who defaults first? It's like a standoff. And that's a network effect that's very hard to break. It's not unbreakable, but it's very hard to break. And that is like a container ship that takes, like a very long time to turn around. Um, and so that's why this is inherently like a slow process. And to the BRICS question, I mean, the amount of dialogue and planning that BRICS has done versus their actions is
Right.
like the ratios. We're always here. We tweet every day about like, oh, BRICS has done this, or BRICS has done this, or BRICS has done this, and it's like, well, what currency still using the dollar? Okay, we'll check back in 5 years. Now, the when Russia invaded Ukraine and got sanctioned, that was an accelerator. So the parts of that that do materialize is Russia and China, for example, increase their trade in their currencies way more. But then you have like a network effect problem, and this already came up. Like India and Russia do a lot of trade, but it's generally more one directional. So India will buy a lot of arms and commodities from Russia, and then Russia will get all these rupees, and then be like, well, what are we going to do with all these rupees? And the problem is like with dollars, we have a really big capital market. We're the biggest, deepest capital market in the world. This with the S&P 500, all of our corporate bond market, real estate, private equity, Silicon Valley. There's a lot of things you can do with dollars. And then of course, because you can use dollars to also buy global commodities, it's a thing you just kind of stick in for a rainy day, at least historically. Whereas all these smaller ones, they have way shallower capital markets, usually way less diverse, often worse rule of law or capital freedom. So like how much money do you want to stick in China, knowing that you might not be able to get it out the same way historically you could with the United States. Um, and so it's been hard for them to build a network effect. And another way of mentioning is that after World War II, and this is why there's nothing that really replaces the dollar. After World War II, the United States has something like over 40% of global GDP, by far the most gold, the only like intact manufacturing base. We were the hyperpower, with only Soviet Union really a contender, and so we were we won by default. Now over time, because of hollowing ourselves out and because of other countries recovering, we've slipped down to 15 to 25% of global GDP, depending if you look at purchasing power parity or nominal. We, now we don't have the biggest manufacturing capability in the world. That's China. Multiple other metrics, our steel making, our energy production, it's all that's gone down. Uh, Ray Dalio has done good research on this, where certain metrics of a country are kind of leading and lagging. So education's leading. So the big, the world powers, and they have really good education, and then technology and things like that, and the economy, and then the reserve currency comes, and then there's earlier things start rolling over, but the reserve currency, because it has network effects, still lasts a long time. It's kind of like how if a social media network is not really cool anymore, it still lingers for a long time because the network effects are so strong. Same thing's true for reserve currency. So all the metrics that made it the reserve currency are on the downtrend, but that's another several decades, and we're decades into that. So basically, there's no current country that has anything that looks like what the U.S. had after World War II. Like China is not in the position that the U.S. was in. Europe's certainly not in the position that the U.S. was in. And the problem is that there's no country that is like the U.S. was at the peak. That was kind of peak world centralization in a way. Um, and that's basically an anomaly of history. So if anything, we're kind of returning to what is normal. If you look at long-term global GDP charts, like China and India used to be really big shares of global GDP. But then in the age of discovery and naval, going around the world, and technological asymmetries. People can look up the Opium War and what basically Europe did to to China and elsewhere. That their share of GDP collapsed. Then they got into communism and everything. They've emerged from those kind of economic dark ages. They kind of returned to their closer to their historical level of GDP growth. So the world's kind of becoming more decentralized as it kind of should be. And so neutral reserve assets are what are kind of reasserting themselves. So gold had a multi-decade trend from like World War II up until around 2000 of a declining share of central bank reserve assets. It got down to like 10, it went from like 80% to like 10% for decades. And for the past 20 plus years, it's actually been steadily increasing. So the big part of that's price appreciation. So gold was a few hundred an ounce in like 2000. Now it's almost 4,000 an ounce. So part of it's price appreciation. And also central banks were reducing their tonnage into around 2009, and they started increasing their tonnage. So the combination of central banks reaccumulating gold and being rewarded with higher gold prices as US bonds have like their worst performance in modern history means that if anything, gold is actually on the verge of flipping treasuries as the number one reserve asset. And so I think what replaces the dollar is not something that looks like the dollar, not like, China currency, enters an 80-year period of being the global reserve currency to the same degree. It's not like that. It's two things. It's one, neutral reserve assets becoming more relevant. So gold's the big incumbent. Obviously, we're both bullish on Bitcoin. Bitcoin is a really powerful one because it's not only a reserve asset, it's also a settlement network. So some of the smaller ones are dabbling in that, El Salvador, Kingdom of Bhutan, some others. Um, and then two, more bilateral trade agreements. So not necessarily there's like some BRICS currency per se, but that, China buys agricultural products from Brazil in Chinese currency, or China buys Russian energy in Chinese currency. So China is kind of a big hub, but not to the same degree. It's more like with their own trading partners. And then to some extent, India and Russia have their agreements, and India and Brazil have their agreements, and kind of a collection of not necessarily friends, but mutually aligned partners have more of their own kind of non-dollar trading situation. And so I think and I've been writing about this literally since 2020, is that we enter a more multipolar world. So not a single fiat currency replacing us, but more gold, more Bitcoin, more bilateral non-dollar systems. And the dollar still might be the biggest for a long time, but instead of being like the only game in town, it's like one of the big games in town. Maybe still the single biggest, but it's a plurality rather than dominant.
Now, in this realm of a world that's more likely to be, as you said, more plural, obviously it makes sense that the U.S. would want to cling to that absolute dominance as much as possible. How much of that mentality would you attribute to the Genius Act and this stablecoin push as not only a way to get more people utilizing the US dollar around the globe, but also to help prop up demand for treasuries when there is not demand? Do you think there's that type of mentality in the play and in the Genius Act and all the things that are happening with the current administration?
I do, and some of them have outright said it. Like, the Treasury, the Secretary of Treasury has outright said that. Um, I think it's natural. I mean, almost every empire in history tries to stay an empire. And this is where sometimes I get the question, is the dollar being the global reserve currency good for America? And the problem is that with 340 million people and different sectors and government versus private, there's no single America. So the question is, who in America is it good for or bad for? Historically, being the global reserve currencies, it's good for those issuing dollars and dollar-denominated securities. So if you're the government, it's historically been good for you. If you're New York and you're issuing all these securities that the world is kind of, we're hollowing out our industrial base, so we're selling all of our assets in Detroit to China. China's running a surplus, and then they reinvest back in America, but they invest in New York issued securities or Silicon-based private equity, right? So we're hollowing out our heartland, propping up our coasts essentially, and we're propping up our defense industrial complex and government complex. That's kind of who benefits. And so those that are running things generally want to prolong as much as possible. They want to fight for everything they have, even though that imbalance is itself what hollows out the industrial base. Um, and so losing the reserve currency status, or at least losing like the dominant reserve currency status, is not a bad thing if it's handled well, because it was an anomaly to begin with, and it came from drawbacks which accumulated and hurt us. So when people ask me, what can you do? It's, well, you can acknowledge the inevitability of the situation and adapt from a period of strength. So you can be more inward and things like that. And you can focus on what gave us the reserve currency status in the first place. It was because we had some of the best education, the best innovation, the best rule of law, the least interference from top-down forces that allows all this kind of innovation to foster. Good legal immigration, so the best and brightest around the world could come here, and an oddly big share of our companies are built by foreigners, for example, because we're the shining city in the hill that people want to be. And obviously, you have to have security and protection from just everyone flooding in. But basically, the combination of things was very powerful. So doubling down on what gave you the reserve currency is still always valuable, but actually having the whole world use your currency as reserve currency is not necessarily that valuable. It's really good for Washington. It's really good if you want to finance your 800 military bases around the world. It's not necessarily good if you want to build something in the United States. It's not necessarily good if you are just not on the side of that. So I think it gives us an opportunity to rebalance things that have been imbalanced pretty heavily for the past 40 years. But if we do nothing and we fight for it fully, then that kind of gets taken from us, and then we kind of lose our empire status from a position of weakness. We spend all of our blood and treasure trying to maintain it, and we gradually lose it anyway. Versus, not just spending resources on what we can't control, instead just kind of go back from position of strength toward that more balanced economy. I doubt we're going to do that. Empires usually don't. They don't say, "Look, we got our borders too big. Let's pull back and defend what we can control tighter." Versus, no, let's try to keep every border we already have against 1,000 different barbarians attacking on it, and then you lose all of it. That's kind of where I think they're headed. Now, the stablecoin thing is one of the attempts to try to maintain demand for the dollar, which in certain parties makes sense to try to do, even though, again, it hollows out the industrial base, keeps that going. Now, I think it's around the margins matters. So it does. There has been de-dollarization at the sovereign level in many countries, but so far there hasn't really been de-dollarization at the individual level. So while, say, the government of Egypt might make more deals with others, people on the streets of Cairo, they still want dollars. They don't want Chinese currency. And that's true for 100 other countries. That kind of bottom-up demand for the dollar still exists and is significant. And stable coins are one of the ways to make it easier to get into their hands. And then, unlike owning a paper currency or a bank deposit, the stable coins are mostly backed by U.S. government debt. Now, the numbers, when you're talking call it $250 billion of stable coins, that's a couple months of our deficit. So we're running $2 trillion deficits a year. So even if we add $1 trillion in stablecoins demand over the next 5 years, that's 200 billion a year compared to 2 trillion a year in deficits. It's not immaterial, but it's not as though it's a golden ticket to just save everything.
Yeah.
And go ahead.
Oh, no. I would concur with that. I'll let you continue, and then I've got a question for you.
Yeah, the only other point is, like, Citi did a really big report, which the Treasury Secretary cited. They kind of estimated a bear case, a base case, and a bull case for how much stablecoins could exist in 2030. And that the smaller number was well under $1 trillion. The middle number was $1 trillion and change, and then the big number was over 3 trillion, I think 3.7 or whatever. And and they kind of worked out, okay, what percentage of money markets wants to be in stablecoins? What percentage of bank deposits onshore want to be in stablecoins? What percentage of foreign dollar bank deposits want to be in stablecoins? What percentage of physical currency holders want to be in stablecoins? What percentage of people that don't currently hold dollars, that couldn't really access dollars, that now they can access stablecoins easier than they could access dollars? What percentage of them will want to hold dollars? So they get to these different numbers, and they get to these figures, which again are not even that big compared to the 5 years of deficits we're going to run over that time period. But then two, they're not even all fresh demand for treasuries, because most of those pools of capital already back some of those dollars with treasuries. So banks in the U.S. back some of their deposits with treasuries. Money markets back a very large percentage of their holders with treasuries, T-bills. Foreign central banks, when you hold the currency of Egypt's holding some treasuries, and they're using treasuries to kind of stabilize their currency power. So, you're kind of shifting from, and I talked with Safedine about this, and he kind of analyzed it similarly, which is you're going from something that might be 20% backed by treasuries to something that might be 80% backed by treasuries, which is material, but it's not all of that is not all of it is new treasury demand. And then again, we're still talking trillion or two compared to the 10 trillion or so of deficits we're going to run over the next 5 years.
Yeah, that's fair. That's fair. Looking for a simple and secure way to manage your Bitcoin on mobile? AQUA Wallet has you covered. It's user-friendly and puts you in full control of your Bitcoin with secure self-custody. AQUA also supports Lightning and Liquid Network, making fast, cheap Bitcoin payments and asset transfers easier than ever. Plus, it even supports stablecoins, giving you ultimate flexibility. Built on open source code, AQUA is transparent, trustworthy, and perfect for beginner and pros alike. Ready to upgrade your Bitcoin experience? Click the link in the show notes or scan the QR code on the screen now to download AQUA Wallet today. Securing your Bitcoin doesn't have to be complicated or invasive. With NUNCHUK's HONEYBADGER plan, You get state-of-the-art multisig with built-in inheritance planning and no KYC required. NUNCHUK is trusted by users to secure billions of dollars in Bitcoin. The HONEYBADGER plan offers 204 assisted multisig, guiding you step-by-step on mobile or desktop. It works seamlessly with hardware wallets like TapSigner, Coldcard, Jade, and plenty of others, so you're always in control. Plus, with non-KYC inheritance planning, you can ensure your Bitcoin goes to your loved ones. No private info needed. Take control of your Bitcoin today. Click the link in the show notes or scan the QR code on the screen to check out the HONEYBADGER plan. Now, again, in this grander scheme of things, with again the world becoming more plural and the U.S., defending, as you said, a bunch of people at the gates. And trying to defend its kind of position of exorbitant privilege, I guess this is kind of a dual question here. What would have to happen, because we in previous administrations saw a lot of antagonism towards Bitcoin, whereas the current one has been very, very friendly. What would have to happen to flip that script again and have the U.S. by and large view Bitcoin as a threat? What position what would have to go wrong in the US, or what would have to go right with Bitcoin in order to see it viewed negatively by the state again? And do you think that is possible? Do you think it's inevitable? I know that Michael Saylor has said that the dollar and Bitcoin can happily coexist. I don't know if you would echo that or not, but I'm just curious your thoughts on that.
So, I mean, it could be as simple as an election. It's still the case that in the U.S., the Democrats, as a big percentage, are less favorable than Republicans. So, a major kind of landslide in that direction. Especially then they can point to some of the crypto fraud and things like that happened either by this administration or during this administration in some cases, and say, like, we got to reclamp down on this and we got to go harder and all that. That's a possibility. The defense against that, to some extent, is size. So I think it's become clear to a lot of Democratic politicians that you don't really get a lot of votes by saying you're going to make your anti-crypto army, or whatever Elizabeth Warren said. You don't really get votes for that. Same thing with, even if you just focus on Bitcoin, they usually use crypto as their term, but if even if they focus on Bitcoin, there's just not votes from being anti that. There's a lot of money and votes that will go to defending it or go to candidates to support it. So I think that ship has somewhat sailed. Where we could see crackdowns, one, and this is something I talked about for a while, which is, even though this administration is more favorable on the whole industry, they're not necessarily more favorable on privacy, or at least to the extent that they are, it's not like a massive change. And so I think we have almost like bipartisan anti-privacy views. So I think that's number one, is that kind of regardless of administration, they're always going to try to find ways to know where your coins are, surveil every transaction you do if possible, make sure they get their taxes, and make sure that they're KYCing everything and all this, and making it either illegal or very friction filled to develop or operate solutions that help others get privacy. But I think it's a fight worth having. I think that's we have to keep focusing on that. But I do think that my bearish view is that that's almost regardless of who's in power, unless you get like a true like Ron Paul type figure or something, you're going to have very anti-privacy practices. As far as simply owning the asset, or mining the asset, that's where you get a little bit more partisan differences that I think are probably going to persist for a while. Those narratives are hard to change on a dime. It's hard for politicians that's been anti something for 10 years to say, you know what, actually I was wrong. It's fine. I like it actually.
Yeah.
So you have to. It takes a while. They can just kind of cool down their anti-rhetoric and become. You can quietly be more neutral on it, or we want to do a sensible regulatory framework, and then they kind of gradually shift more positive. If it gets truly big, and like ironically, 2 trillion is not big. This size is not size at the U.S. level. If you start to see kind of years of like currency crisis in the U.S., and politicians can then like who's benefiting right now because China's eating our lunch, and we've actually let them eat our lunch. We've helped them eat our lunch in terms of industrial production. And now we use China as a boogeyman now, even though this was largely we like rose them up and then literally helped them get our industrial base. And so they did what was rational for them, and we did what was good for our corporations and our government, not as great for the people. But we, for whatever, even though we worked together to do this, we now blame China as though they just did this to us and we were victims. I think the same thing could happen with Bitcoiners. If Bitcoin's a $10 trillion market and the dollar index is lost a third of its value and inflation's been above trend for a long time and poll numbers for the administration are bad, it could be the next administration, whoever is in charge, if their numbers aren't great, it's like, well, those Bitcoiners are, it's those darn Bitcoiners and their decentralized spreadsheet, and how dare they trade among themselves, and how dare they have their own kind of scarce unit. They're the ones damaging our currency. Then you could get more crackdowns. It'd be a similar version of what you see in emerging markets, where when an emerging market or developing country has a currency crisis, you'll never really see a president come out and say, "We messed up, guys. Sorry." It's speculators and traders, foreigners are going after our currency. So that's why I have to do capital controls to stop those mean people from speculating on our currency. And there's always some truth to it, ironically, because in fiat currencies, weakness begets more weakness. So if a currency is weakening and they're not willing to raise interest rates enough to solidify it, then entities will say, "Well, I'm going to short that currency then, and I'm going to borrow Turkish lira, and I'm going to buy dollars or gold or Bitcoin with it." So then they try to do capital controls, which then says, "Well, why would I ever invest in Turkey if I perceive that as happening?" You replace whatever country you want, and that happens all the time. But we could see that increasing out of certain developed countries, places in Europe, Japan, the United States, where they say, we're weakening because not our own fault. It's not our own mismanaged entitlement system and bloated Defense Department, and just decades of bad decisions and the war on terror that accumulated trillions in debt. It's not that. It's the Bitcoiners. It's China. It's XYZ. The same thing happens with like surveillance. So like after 9/11 happened, we do the Patriot Act. We usher in decades of new surveillance and kind of infringements on certain rights, and then it bounces around. Like right now in Europe, like the whole digital ID stuff, we want to surveil everyone. That is kind of coming out of the more of the left-leaning side to some extent. But then in the U.S., for example, we talk like the current administration ran on ending the deep state, and it's like, well, are we replacing the deep state with like Palantir?
Yeah.
And like, so, and then you can change the rhetoric. It's like, well, now, it used to be maybe you want to surveil everyone to make sure, quote unquote, like right-wing extremists aren't doing bad things. But then you say, well, we have to surveil everyone to root out the immigrants, the illegal immigrants. So you can always, and again, there's like grains of truth. Like, sure, that's an actual problem. But then the question is, do you want to surveil everyone? You use an actual problem as your justification for why you need either capital controls, surveillance, inflation, things like that. That's the thing that keeps coming up. And like an example I cited in Broken Money was Christine Lagarde in France was basically talking about why even small amounts of financial privacy are potentially bad or risky, because that one terrorist attack, they used like anonymous prepaid cards to fund it or whatever. She cited that, killed dozens of people tragically. This is a country of tens of millions of people. A tiny percentage of deaths happen because of terrorism, but they use that horrible edge case, and they say, well, that's why like no one can. We have to have limits on how much you can do cash transactions before it's illegal, or we have to surveil all your accounts. So we have to KYC everything. We have to make sure that there can never be someone who kills a few dozen people, even if that means reducing the rights of tens of millions. And if people get scared enough, or if oil is $200 a barrel, and they can't afford gas in their tank, and the politicians like it's the Bitcoiners, it's the that's where the risks come from, is when you enter crises, you get scapegoats.
Yeah. Well, on the bright side, The quality of life and birth rate inside of the gulag will be far better than outside of it. So, we'll all the Bitcoiners
Yeah.
meet up there. So,
Yeah.
Lyn, now I regularly go to you to help myself understand a topic that is not my forte, which is kind of the macroeconomic stuff. And it's incredibly valuable to me. And of course, I find myself in kind of more the technical day-to-day practical tools in and around Bitcoin. And so my question for you, or to turn it around, to flip the script a little bit, and this could go one of two ways because you do have an engineering background. I'm just not certain what tools you're playing around with, but do you have any sort of a maybe technical Bitcoin question, but in and around day-to-day tools for me? And if not, if you're pretty well versed in and around that, what is currently piquing your interest in the Bitcoin space as it comes to applications or devices or technologies that individuals can use?
Yeah, good question. So with hardware, I go through waves of getting up to speed on certain things, but then because like I'm focusing on macro, I'm focusing on Bitcoin, I wear a bunch of hats. I kind of then put those on the side burner for
Mhm.
a little while. And so, for example, I found NUNCHUK and tap signers because of videos you did.
Oh,
And so that was helpful. I love those products, um, and among others. So I guess my question would be, like, what are your current kind of favorite or upcoming products that you generally recommend, either to kind of day to day use for a lot of people? And I guess part of my selfish reason for asking that is so for those that don't know, like I'm a general partner in Ego Death Capital. We technically raise the biggest Bitcoin focused venture fund, individual fund, with the second fund. And so we invest in, it's mostly software. Um, but I always like to hear, especially because you're more technical and more kind of focused on this, what things in general, not whether it's a specific product or just trends you see that you're looking at, because I certainly gained from stuff you did years ago, and I've not really had time to, especially in hardware, haven't focused on things.
yeah. I mean, yeah. It's cool that you brought up Nunchuk, because they just rolled out, mini script, in their mobile wallet, which is super cool. So I guess anybody listening that doesn't know what the hell is mini script, it's you can use it in the context of a multi-sig vault. So picture a digital vault that requires multiple keys to open. But you can set certain conditions over certain periods of time. Like maybe right now you have two keys and you require both keys to open the vault. But after a certain threshold of time, a third key becomes available to also use, and you at least require two of those three keys. Or the opposite way around, where the three keys are present off the hop and you require two of them. But after a certain threshold of time, if the funds haven't moved around, then you're only going to require one key. So you'd have like a deprecating one. And so you can have all of these things, or you could have, maybe institutions dealing together where each institution has a 2 of 3 multisig, but each institution has to successfully execute their 2 of 3 multisig, which is like part of an aggregate 2 of 3. So you can have all of these different conditions, and now it's accessible to the average person. And so they've rolled out kind of just general tried and tested templates that you can use. But you were referring to tap signers. The demo video that I did was using tap signers for that function. Cold Card, of course, has that. There's more hardware that are rolling out mini script functionality. So I think that's super unique in that you can kind of almost set like an inheritance plan technologically without any third party even truly involved. And it's just somebody can just have a wallet and they have a key, and the key doesn't work right now, but at a certain point in the future it will. And then they'll just have access. So I really love that kind of stuff. The other thing that I use the most that I think Bitcoiners are asleep on is we all dick around with so many different wallets. And I'm sure people have seed phrases just kicking around everywhere. BIP85 is a godsend. And if anybody's unfamiliar, the idea is you have one master key, and you can derive all of these child seeds from it. And they're all, again, directly derived from the master. So what you can think of is you got a hardware wallet, you've got maybe multiple hot wallets for different purposes. Instead of storing all of those seeds in one place, now whenever I try out a new wallet, instead of generating a new seed, I go to my cold card and I say, generate a new seed for account 11 or whatever. And it spits out a 12-word seed. I no longer need to write down and back that up, because if I have the phone on my wallet and I delete it by accident, I go back to the cold card and I say, what was account 11 again? Spits out the same seed. And even if I break the cold card, I just have to secure the one seed for the cold card to regenerate all of that. So I've done that for family members too, where I maybe, I say, I trust you with this device and this seed, but really secretly in the background, I'm the third line of defense if my mom smashes her device or loses it and also loses the piece of paper. Like, it's just in case. So I'd say those are, mini script in terms of the new up and coming thing that I think will take hold quite a bit over the coming years. And BIP85 just is like a great tool for the Uncle Jims or Aunt Janes of the Bitcoiner community that are helping the other Bitcoiners around them, I'd say.
Awesome. Yeah. I saw the mini script introduction. So I agree with you. I'm bullish on that.
Yeah. And Anchor Watch, they're doing great with that too. Like
I think there's a whole untapped field of really good kind of setups that can either reduce our risk or back things up, and I think it's powerful.
Yeah, absolutely. Now, just a couple last lighthearted things I wanted to quickly tease out at you beforehand. Now, I've heard that you're into anime. Is that true?
Yeah, to some extent. I used to be, and in theory, I still am, but I don't watch a ton of television. But yeah, I've always liked the medium.
Okay, so as somebody that's uninitiated into anime, what is a kind of perfect first entry point to anime? Maybe something that might be noob friendly to kind of dip my toes in, and then other than that, what's your all time fave?
That's tricky. I mean, if people don't mind dark stuff, Attack on Titan is usually a good entry. It's very violent, but it's especially like the first season is very it's like action horror, you can call it, with a lot of emotional depth of characters. Really high quality animation. It kind of became quite popular for a reason. So I think that one's not like a kid entry point, but like a good entry point if someone's in their teens or an adult. My favorite of all time has got to be Cowboy Bebop. Nice. It can be a little tricky to get into because now it's getting close to 30 years old, something like 27 years old. So it came out in the late 90s. It's 26 episodes, but it's the structure of it is only a handful of those episodes are like the core plot. There is a beginning, middle, and an end. It's one complete story told from the beginning. Most of the other episodes are episodic, so it follows like they're bounty hunters. If anyone saw Firefly or the movie Serenity, it's that kind of vibe. Like you're kind of like down in your luck space bounty hunters, with a really kind of colorful cast of people that are all like eccentric, and they're hunting bounties and usually failing, and doing all this stuff. But then behind that, there's a really serious plot. And so a lot of people would consider that a masterpiece, and I'm generally one of them. But it's like not everyone kind of gets it. It's kind of a vibe, and if you're vibing with it, it's like amazing. And then they had a movie that takes place toward the end of the series, came out after the series was done, and it's kind of like them going after their biggest bounty ever. And I think that's an incredible animated movie that you don't necessarily have to see the series for. If you just know that this crew is like a bunch of bounty hunters and they're after this like mega terrorist, that's kind of all you need to know. So you could actually that could also be an early entry if someone wanted to get into that. So that's probably my Rex.
Awesome. I love it. Last thing here. I heard, are you a black belt in some sort of combat sport, or have you trained in combat sports? I thought I heard that somewhere.
I did 12 years of martial arts, and from like age 7 to like age 19. and I technically got a secondary black belt in karate, which in our school was a combination. It was basically MMA before we called it MMA. So it's now actually that federation rebranded to MMA, but it was kickboxing, submission grappling, and traditional karate.
And did you retain some of those skills?
I certainly have some of them. I can still grapple, and I know how to throw a punch and kick and stuff. I'm not as quite as conditioned. I've also doubled in age, so.
Okay, well, here's your hypothetical. You get to pick one of these, the one that you're most likely to make it out of alive. You have the choice of fighting 5 Natalie Brunels or 1 Robert Breedlove. which you taking?
Neither. I don't know. I would say from experience, it's harder than you think to fight multiple people. At least like I have fought bigger opponents. At least I know how to approach that. So I'd probably try Robert and lose. I think that, I would at least try that approach.
Fair enough. Final simple question. I've started a bit of a rift here well, completely on purpose. So I asked Michael Saylor, and I asked him whether he preferred cast iron or stainless steel. And then I asked Saifedean what he preferred, and it would seem that they're never speaking again. So for the final question, to settle it once and for all, Lyn, cast iron or stainless steel?
It's kind of a blasphemy, but I'm on the Saifedean stainless steel side of that. Now, I would caveat that if someone's like an aficionado, if someone really enjoys maintaining iron, cast iron is like the expert choice, whereas stainless steel is kind of the better engineered, set it and forget it choice.
All right. Well, we're going to log one for stainless steel. Twitter's going to have a field day with this. So I hope you're ready for the blowback.
Yeah.
Awesome. Well, Lyn, thank you so much. I will link everything down below. Is there anything you want to point people towards to go check out?
People can check out lynalden.com. That's where my research is. Broken Money on Amazon or elsewhere, or Safe House. You can buy it in Bitcoin or Lightning. So thanks for having me on.
No wonder you went stainless steel. Your book's on the Safe House.
Yeah, I'm actually a Saifedean shill. So it's contractually obligated to say it's stainless steel.
Yeah, exactly. Awesome. Well, Lyn, thank you so much for your time. I really do appreciate it. And I look forward to seeing you again, both digitally and hopefully in person sooner rather than later.
Yeah, looking forward to it.
Hey, you. Yes, you watching the Bitcoin price movements and the latest exciting news. It's awesome to stay informed, but the real power of Bitcoin comes from taking control. Don't just watch, take action. Head over to btcsessions.ca/learn for free step-by-step tutorials that guide you through every major skill you need to know, plus full video playlists for deeper dives on any topic you like. And if you're ready for the ultimate fast track, scroll to the bottom and check out bitcoinmentor.io for premium one-on-one experience with my team of Bitcoin experts to ensure you get it right the first time. Don't wait. Secure your Bitcoin future today. Hit the link in the show notes or scan the QR code on the screen.